and welcome back to another MRMIA Broadcast. I'm your host, Marc Leprince, and you guys are listening to the Model Risk Managers International Association broadcast. Today, we're continuing another credit scoring series with Raymond and Pravin, and we have them back here today as returning guests. So, Raymond is a published author in the credit intelligence and scoring area with over 25 years of practical experience. Pravin himself also comes from a similar background as CEO of Analytix Engine, a boutique credit and ML modeling consultancy with over 20 years of experience in credit modeling, model risk management, and was a previous partner at Deloitte, South Africa. So welcome again. So today's topic and what we're gonna title this episode is Finding the Lighthouse in Stormy Seas, Seeking Direction in Challenging Times. And I know that we wanted to focus on using benchmarks to kind of help with that. So Raymond, perhaps you can introduce what is benchmarking and what is the purpose of it?
Thanks, Marc. First, I have to comment on the change in decor. I can see that you're now getting in a little bit of the feminine touch, although she hasn't entrenched herself totally yet. So, if you have the chance, maybe you could change your mind.
Yeah.
But in any event, that's just an aside. You could. So benchmarking is basically saying, what do we compare ourselves against? That is with respect to whatever measure you wish to put out there. For a lot of the models that we're going to be looking at, it's going to be the probability of default or the exposure at default, loss given default, blah, blah. And it could be coming from almost any source, even internally. You could be benchmarking yourself against other products, against past performance, against data from other lenders, the industry as a whole, and so on. So it's really the lighthouse. You're trying to say those benchmarks or lighthouse that you're going to say, okay, shouldn't that be about where we should be heading? But is that not where we want to be? Or, well, actually, lighthouses are supposed to be indications of danger, but they are guides. They're guides to get you through the stormy seas.
Excellent, excellent. And so considering kind of the stormy seas that we're in right now with the pandemic, continuing infections going on and sprouting in various countries throughout the world, is there anything we can codify from these shocks, pandemic or otherwise?
Well, I think a big thing is realizing that the things can happen. That in South Africa they say "kak gebeur," which is basically sort of shit happens. Excuse my French. But if you're looking at a lot of things, sort of a lot of entities chucked out the models. They said we don't know what's happening anymore, and basically they went back to either judgmental decision making or basic policy rules. And the one thing with the policy rules is that they tend to have developed over eons, or at least years, and they are kind of practically a part of the institutional memory that should not necessarily be adjusted based upon what's happening at any point in time. I may have mentioned this before, but back in the late 2000s, when it was the Great Recession, prior to that, my employer, and I was driving it, we checked out a lot of policy rules because they didn't seem to apply anymore. And then the Great Recession hit, and some of the top guys were saying, well, hang on, those things were there for a reason. So you do not throw out such things lightly. But beyond that, you're going to be looking for the indications, things to anchor to. So looking at the credit bureau and what's coming out of the credit bureau, the kind of credit rating agencies, as indicated, potentially other products, or what happened during the last crises. And one of the things that people were looking for during this one was to say, okay, what happened back in 2008, 2009? Where did it end up there? That was a benchmark for a lot of people. The one is going to be also trying to say, okay, where are there differentiations by the market segment or based on the market conditions? Can you sort of use one industry to compare against another to find where the deviations are? And so it goes a long way. But ultimately, the goal is to kind of have those anchors that you can almost look to. So the other things were prior or borrowed models, potentially the challenger models. If you are using sort of some of the more avant-garde techniques for doing predictions, neural networks, random forest, XGBoost, they tend to be volatile. The logistic regression, linear programming, so a lot of the other parametric techniques are going to give you more stable results. So they can be kind of used as benchmarks as well as potential things to come in should the more fancy models prove deficient. And also even just stuff on other products. If you've got credit cards, well, how are the home loans doing? How is the motor vehicle finance doing? And a lot of this is not just the relative rates, it's going to be what is the direction? Does one potentially lead the other? The saying was way back when about you can sort of, you can't drive your home to work. Well, that was back in 2008, 2009, where they were saying that. And the home loans, they were being affected, but sort of vehicle finance was not being affected as much, just because of sort of the changes in values. And but like nowadays, that's different with the work from home. So, but what are those moves? Are they different products or segments that you're dealing with moving in the same direction? And also, are there different segments within your portfolio that are moving at different speeds, either up or down?
Right. So we've kind of covered some of the things you can do in terms of rules and policy rules that you guys can codify. And then we've looked at things that you've used as benchmarks from bureau scores, rating agencies, challenger models, and looking at what's going on in other products. Are there any tips for benchmarking and establishing those kind of guides during these uncertain times that would make the scorecards themselves or the benchmarks immune to shocks?
Well, okay, there's no magic bullet. You're never going to be able to make it immune. And even where you do have benchmarks, those benchmarks may react at different rates. The like the grades provided by the credit rating agencies are known for being sticky. They do not necessarily react quickly to shocks. But should they necessarily react quickly? They are supposed to be longer term indicators. And but it's one thing that one has to keep in mind is that you may have your own situation may be moving very quickly, but the benchmark may not react as quickly. And the other aspect is that there is no real typical shock. So we've got the different types of shocks. I mentioned there being conflict. You've got the economic shocks. You've got those arising from natural disasters, amongst others. So it's very difficult to kind of future-proof yourself or shock-proof yourself.
Right, right. And so,
although the one point was the aspect about the simplicity. If your models aren't simple enough to handle changes, then have a simple option as a backup in the cupboard to be hauled out in need. And the simplest are the policy rules. But if you're using a neural network, you'll have a logistic regression model sort of somewhere in the cupboard.
that's right. And so, building on that, if there's no kind of typical shock, there's no silver bullet, what activities can MRMG teams and modeling teams do to actually improve a model or benchmark's ability to handle these shocks?
I was going to say buy crash helmets. I think crash helmets is a good thing. Going around on a roller coaster, you can get your brain a little bit rattled. But besides the simplicity aspect, trying to sort of bring in data over longer periods, or to keep the data from past shocks in reserve to go back and use as reference points. So many, of course, sort of like the Spanish flu was a century ago. They didn't have computerized systems. The documentation from that era ended up in the dump many kind of decades ago. But nowadays, with sort of storage capabilities, much of what we've got could be put away. Granted, the data formats and stuff changes quite quickly, but it could provide value. If nothing else, to sort of say, okay, this is the type of volatility that we saw. Also, as time progresses, with the techniques and methodologies that are available for scenario testing, they can be used as as test data to run through new approaches.
Right, and kind of use that data to evaluate the what if scenarios. So,
yes.
I'm going to address this kind of next question to Pravin. So let's assume as an institution we were able to collect this data. I know from the current pandemic, I know just about every bank is tracking the data live. What should these teams be doing with the shock data?
Excellent question, Mark. And as I talk to lenders, they often will tell us the 2020 was a strange year. 2020 was atypical year. And 2021 looks like it's going to be better. We're not quite sure yet, but it looks like it's going to be better. And things are starting to normalize, and hopefully. And as soon as they normalize, we'll start rebuilding our models or recalibrating our models. But life is never that simple. So one of the questions we have is, what do you do with the actual data, exactly to your point, from this period? Because if we are going to rebuild our models, let's say in the second half of 2021, what do we do with data from the past 18 months, which we admit is atypical? But the question then becomes how atypical? And therein lies the $20 million question. To what extent do we expect the second half of COVID, assuming we are halfway through it, to repeat itself? We know we're not going back directly to 2019. The truth is probably somewhere in between. And so the question arises, and the thing that banks need to, and all lenders need to start thinking about is, if I'm going to be recalibrating my models, my scoring models, my impairment models, my capital models, coming out of this COVID period, how do I treat my COVID data? What of it do I believe is typical? What of it do I believe is atypical? And how am I going to normalize and recalibrate my models to be useful going forward? And that is not an easy question to answer. The textbooks have the standard methods of dealing with outlier data. But the honest answer is there is a richness in this data, which may be atypical, but parts of it do lead us to a new normal. And so the quicker companies start thinking and lenders start thinking about how are we going to recalibrate our models for 2022, how much of 2020 and 2021 is normal, the more likely we are to recalibrate sensible models for 2022 going forward. So that conversation about the treatment of the data and the experience of 2020 and 2021 needs to start now, so that banks can start framing their thinking so that they can better calibrate their models going forward. But on the one side, you might want to remove the 2020 experience because it looks so bad or so different. But the flip side of that is, because it looks so different, you actually want to store it for the longer period. And I mean, as we've been talking, we've been mentioned a few times, can we look to previous crises, previous periods of stress to help inform our response now? And one of the biggest problems many organizations face is that their data warehouses don't go back far enough. And so the question is, we now have a golden opportunity to store data from this crisis, to have it available to inform future thinking and future research. So one of the things we do is not just put it into our data warehouse like we normally do, but actually store a copy of it, specifically flagged and locked away in an easily accessible place. It's interesting to say locked away in an easily accessible place, but in a place where we don't allow it to be cold stored, in a place where it's easily reachable, so that future generations of credit analysts in our organizations have a folder they can go to that says previous shocks, and they can find the data from this shock to help them study shocks, together with data from previous shocks and inevitably future shocks. So that's quite important. On the one hand, we might want to remove it from the calibration of the 2022 models to some extent, but on the other hand, we want to store it so that we can use it to study shocks in future. The other use of the data, which is less obvious but quite important, is to look at our stress testing models. So if we look back to our stress testing models and our scenario analysis models, whether you're doing IFRS 9 or CECL now, your forward-looking models, if we look through the stress tests that we had and the downside scenarios that we modeled there, how does that compare with 2020 and 2021? This is an ideal data set to compare with our previous downside forecasts and to say, what did we forecast? What did we believe was possible versus what happened? And for me, depending on the segment you're in, what you found is varying degrees of the size of the stress. But the more interesting thing about this period of stress is the length of this period of stress. Most periods of stress tend to be a few months of duration, but this one is actually extended for a much longer period. So certainly looking at your forecast models and your stress testing models and comparing with this period of data is actually really useful.
Yeah, that's really, really interesting. Because trying to, that's something I didn't even think of, is using this pandemic as kind of your actuals to compare against a stress test forecast. is something very interesting. So looking beyond just kind of these teams, let's take it to a broader level of what is the impact to the customers, and more specifically, how does these how do these credit providers continue to treat their customers fairly through these periods?
A very interesting question, and actually one that probably doesn't get enough airtime. Um, when we were studying banking and learning about the banking system, one of the common topics that comes up is banks want to lend you money when you don't need it and don't want to lend you money when you need it. If you wealthy, financially sound, you get a good credit score, and banks are happy to lend you. When you in times of distress and don't have a solid credit score, banks are less likely to lend to you. But that's almost treating the topic of treating customers fairly at a fairly superficial level. If we actually dig down a little bit into it, what does it really mean, and what are the dimensions that we should be looking at in terms of treating customers fairly? One of them, I think that's quite important, is to look at your treatment of individuals, because customers are people. And how do we treat them across time? So how did we treat a customer, Pravin in my case, 5 years ago? How did we treat him 2 years ago? How did we treat him when he wanted to borrow money? And now when we've gone into lockdown, how did we treat him when his income dried up? So who did we offer forbearance to? Who did we not offer forbearance to? How much forbearance did we allow? And who did we offer special arrangements to? Who don't we offer special arrangements to? We need to think about that not just across customer segments, but across individuals, and our consistency of how we treat customers across time. That is quite important, because customers remember, and this is actually the time within the right customer segments to be making customers for life. So the first dimension, I would say, is looking at customers and how you treat them over time. The second dimension, I would say, is within a segment, because when it comes to treating customers fairly, we want to be able to show, and the asset test is, are you happy for your customer talking to his neighbor to share how he was treated by his bank? And the answer is probably yes, you do want that, because then hopefully his neighbor would join your bank as a customer. But that's only possible if you're treating him fairly. So the question is within a segment, and it's an important question as to how you define a segment in the first place. But within a segment, are you treating customers fairly? When it comes to limit allowance, when it comes to restructuring, when it comes to bias and unconscious bias, if we compare customers within a subpopulation, are you treating those customers fairly? And if we were to benchmark a segment and we look at customers not in the middle, because in the middle we're fairly consistent, if we look at the edges of a segment, the top and the bottom, how are we treating them differently within the segment? And are we able to benchmark our treatment? And do we even benchmark our treatment of our customers to start with? So within segments, customers like you, are we treating you consistently? Firstly, philosophically, and then practically through our policies and procedures, but actions, most importantly. Then if we look across segments, you have cliff effects. At a certain income level, you suddenly belong to wealth. At a certain level, $1 less than that, you don't. What is the consistency of our treatment of those customers across segments? Do we have cliff effects in the treatment of our customers? That $1 less and you mass market, $1 more and you wealth, and then that treatment changes hugely. So what is our consistency across segments of customers, but also across products, right? In your unsecured lending, you've got personal loans, you've got credit cards, you've got overdrafts. How are you treating those customers consistently? Often banks run on a product house basis. So the question is, across those segments of customers, across those product segments, are we treating them fairly? And it's not just about responding to special needs while they're good and allowing them breathing space, but also in our collections, right? So which customers are we willing to be proactive about helping and doing a restructure, doing a payment holiday, doing an interest-only adjustment. Which customers are we willing to be more collaborative with and helpful in our approach to resolve their indebtedness, to give them breathing space in the hope that they will return to a new normal, whatever that may be. So it's not just simple as saying we have a scorecard, we're consistent within that scorecard. It's also about our collection strategies, who we send to collections, whose houses do we foreclose on first. And it's important to look down not just at the first level of data to say that it's people with a specific score, but we need to look lower to say, by socio-economic segment, are we being fair? And are we being proactive about being fair? Remember, customers have a reasonableness expectation, and this is a topic I was discussing with one of my friends recently. And the question is, what is fair? What is a reasonableness expectation of our customers? And one of the things that came to mind is, who is the advocate of customer reasonableness in your organization? Who is actively championing the customer in your response to the customer, both in terms of foreclosing on certain customers, but also in assisting other customers? Who is your customer reasonableness advocate? And one of the suggestions we came up with is, you want someone who's financially astute and understands the business of lending, because business lending is a business. So you probably want a retired risk professional who doesn't have the KPIs that business have today in terms of managing risk and capital and all of the usual benchmarks, but understands them and understands the constraints that management faces, but also is able to come in terms of crisis, in terms of stress, and help challenge management and step back and make positive suggestions as to how we positively advocate for customer fairness.
That's right. That's right, Pravin. And I think this is a topic that often gets overlooked, but it is so essential because they're part of the business. They're how these institutions make money. And so, you know, in light of trying to keep treating customers fairly, how do we balance the needs of the business itself and balance the needs of the credit provider so that we don't overstep our bounds or, get into some kind of financial ditch ourselves?
And life has to be fair, right? So on the one hand, we want to be fair and treat our customers fairly, but on the other hand, we have regulators, we have shareholders, we have other stakeholders. Lenders play a critical part in our economies, and we have a social responsibility to act responsibly. So that risk-reward fairness trade-off is actually not as obvious as it sounds. But one of the ways to start addressing it, to look at it, is to be proactive, right? So what is your risk appetite? And risk appetite is not about a threshold on a graph somewhere. It is in some cases, but it's much more than that, right? It's about how we make decisions, but also how we inform those decisions. So yes, we want to help as many of our customers as we can, but if we go out of business, we're helping none of our customers. So what is that threshold that we're willing to go down to in a period of stress, so that we're willing to dip into our reserves that we built during the good times, so that we are able to help our customers? But how do we do it up to a level where we don't threaten the financial viability of our business long term? Because as I say, if we go bust, we're not helping any of our customers. So for me, it starts with risk appetite, and it starts with the richness of your risk appetite. Risk appetite is about a trade-off between conservatism and market share fundamentally. And market share grows by treating your customers fairly. But without some level of conservatism or fair decision-making and sound financial principles, your business is not sustainable. So your question is very well-founded. If we look at customers and customer loyalty, which is what we fundamentally want to build, right? Because the purpose of dipping into your coffers to help your customers is ultimately to build market share and to build customer loyalty. So the first question we have to ask is, who do you want as a customer? And have you answered that question to start with? Which customers do you really want to retain? And do you know who those customers are? And then if you know those customers, what is the extra mile you're willing to go to? So the first part is, how much strain are you willing to take for those customers? How much of short-term cash flow are you willing to sacrifice in return for a longer customer lifetime value? And that asks 2 or 3 questions fundamentally. The first one is, how much are you willing to invest? How much are you willing to dip into your shareholder equity, your retained surplus, the total equity that you have and the capital that you have? So how much, what is your floor in normal times, and what is your floor in periods of stress? And they can't be the same. So how low are you willing to go? The second question is, for how long? And I mentioned this earlier. When we look at COVID, one of the fundamental differences about COVID is the length of time that it's affecting us. So the first question is, how much are we willing to invest in helping this customer base? The second question is, for how long? If we're willing to do a restructure, if we're willing to do a payment holiday, if we're willing to do an interest-only loan, for how long are we willing to carry that customer? Because at the end of the day, it can't be indefinite, right? Do we have a view? And how does that view vary by size of customer, by size of loan, by customer segment, with the view to being consistent so that we treat them fairly, and with the view to a view that we are comfortable enough to share those principles with our customers? Because at the end of the day, as much as our customers want to help them, our customers are realistic people too. The last part that's very important around that is on what terms. What is our philosophy and strategy around helping customers? To what extent are we willing to extend loan terms to reduce the installment? To what extent are we willing to ask for or be more flexible around collateral? Very importantly, if you're looking after financial soundness, in periods of stress, collateral itself could be devalued, and do our models allow for that? And to what extent are we willing to keep interest-only payments? Because the moment a customer stops paying, to get them to start paying again from scratch is much harder than adjusting a payment facility and maintaining a relationship with that customer. It's important, in order to run this soundly, that we have dollar limits, but also principal limits. Dollar limits tell us how much we're willing to invest, how low are we willing to have our capital go, etc. And our principal limits say, for example, we have certain common covenants on our fundings, and we're willing to go up to a certain level. During a 1 in 20 year event, we're willing to go to a certain point, but during a 1 in 25 year or a 1 in 50 year limit, we're willing to go to a different point. This, for me, again, and I say this often, is the time to buy loyalty. But in order to buy loyalty responsibly, we need to buy it in the right segments, with the right business action, with the right controls in place. It's an ecosystem that we need to nurture and look after.
Absolutely. Absolutely. And I think this is a very good way to codify the direction the bank should be going in, right? Identifying the customers they want to keep, at what level they're going to go to keep them. And that should give, these institutions kind of that lighthouse or that guiding light that they can follow in these kind of stressful times. So Raymond and Pravin, thank you once again for such a fantastic discussion.
So you're signing off a bit quickly here. Just
okay.
We've got time. I'm hoping that we've got a bit of time for this. But just a couple of points. What Pravin was just saying about customer loyalty. The 1908 San Francisco earthquake. Lloyd's of London was the only insurance company that honored the claims. It was part of the reason why Lloyd's of London became one of the foremost insurance companies in the world, because they stuck by the customers and paid out their customers. As a result, they had people flocking to them for decades thereafter. So another point, this is a bit of a joke. This comes via a colleague called Tim Paulson. Relates to the collections. How would Jesus collect a past due debt? If you don't pay, I'll tell my dad. So I just loved that when I heard it. It was actually his wife that came up with it. But he's involved in collections. But in any event, sort of there's a lot here. Sort of, it might be turbulent seas, but sort of we're learning a lot. As indicated, the whole thing with model risk management kind of started coming to the fore at post the 2008, and right now those that little bit that we've been trying to put in place is being tested.
Mm-hmm.
So who knows what the future is going to bring.
Yeah, absolutely. Time will tell. And with that, I'll I'll close this out. And to the MRMIA folks watching, please tune in on our next MRMIA broadcast and another edition of this continuing credit risk scoring series. So take care.
Sure.
Thank you. Take care, everyone.
So thank you. Bye-bye.